Back on December 9th, 2025, the Economic Times put out a report that, honestly, should have made every single person in the financial news world just stop whatever they were doing and stare at their screens. We are talking about something that changes the whole game. It's about JPMorgan Chase. Now, you have to understand, this is the bank that spent decades, and I mean decades, keeping the price of silver down. This is the institution that had to pay out $920 million in fines because they got caught manipulating precious metals markets. They were the ones accused of holding the biggest naked short position, which basically means selling stuff they don't have in the history of commodity markets. But then, out of nowhere, they just completely flipped sides. It's kind of wild when you look at the timeline. Between June and October of this year, they didn't just quietly close out their short positions. They wiped out their entire paper short position, which was massive. We're talking 200 million ounces. But they didn't stop there. They didn't just say, okay, we're out. No, they went on what is probably the biggest buying spree for physical silver that we have ever seen in modern history. They bought 750 million ounces. Let that sink in for a second. That is not a typo. That is 750 million ounces of actual, real, deliverable physical silver. I'm not talking about paper contracts or shares in some ETF. I'm talking about real metal, sitting in real vaults, with real security guards protecting it. To give you an idea of how big that is, let me put it in perspective for you. That amount is almost equal to an entire year of global mine production. It's more silver than most countries even have in their strategic reserves. At today's prices, that is worth about $22 billion. And you have to remember, that is just what it costs them to get in, before silver really takes off. This isn't some hedge fund making a little gamble. This is JPMorgan Chase. They have $39 trillion in assets. When they move money like this, on this scale, they aren't just trying to make a trade. They are getting ready for a total transformation of the market. Just think about what this actually implies. For years, JPMorgan was the biggest force keeping silver prices down using derivatives. Traders even had a name for it. They called it the JPMorgan short. It was legendary. Every time silver tried to go up, to $30, $35, or $40 an ounce, these huge sell orders would just mysteriously appear on the COMEX exchange, crushing the momentum and scaring all the regular investors away. But now, they have zero short contracts. For the first time ever recorded, JPMorgan is long on silver in both the physical market and the paper market at the same time. This isn't a hedge. They aren't trying to balance a portfolio. This is basically a declaration of war. But the twist is, they have switched sides because they know exactly what is coming down the pipeline. See, here is what JPMorgan figured out before anyone else did. They realized that the mathematical trap the market is in isn't something you can escape with paper tricks anymore. Let me walk you through the 3 dominoes that are already starting to fall, and why, once one goes, the next one has to follow. The first domino is the physical supply. It has basically vanished. Look at the silver lease rates. That's the cost just to borrow physical metal from someone who has it. Those rates spiked up to 35% in October 2025. Think about what that number is telling us. Banks are so desperate to get their hands on physical silver that they are willing to pay 35% annualized interest just to hold on to it for a little while. Just to have possession of the metal for a few months. There was a market insider who told Bloomberg, and I'm paraphrasing here, that nobody has any silver. Lease rates are 20 to 30%, and that's only if you are lucky enough to actually find someone willing to lend it to you. This isn't just normal market stress, folks. This is what a systemic breakdown looks like right before the news headlines catch up to reality. Then you have the second domino, the COMEX registered inventories. This is the metal that is actually available to be delivered against futures contracts. Those inventories have collapsed to 15-year lows, but at the same time, the open interest, which is the number of paper contracts out there, has exploded. The exchange is now operating at a ratio of 244% paper claims for every piece of physical metal. Let me translate that into plain English for you. For every single ounce of silver that is actually sitting in a COMEX vault available for delivery, there are 244 paper contracts claiming they own that same ounce. That isn't a functioning market. That is a game of musical chairs where more than half the people playing aren't going to have a seat when the music stops. And the third domino? Industrial demand. It's not optional anymore, and it is accelerating fast. We're talking about solar panels, electric vehicles, 5G infrastructure, data centers. These technologies chewed through 1.2 billion ounces in 2025 alone. And unlike investors, who might stop buying if the economy gets bad, industrial consumption is locked in years ahead of time. Manufacturers can't just decide not to build solar panels because they need silver paste for the conductors. They can't make semiconductors without silver interconnects. They can't make electrical contacts without silver alloys. The production lines don't stop. The purchase orders don't get canceled. This consumption is baked into the global infrastructure build-out for the next 10 years. So, JPMorgan looked at these three things coming together: supply vanishing, inventories collapsing, and demand soaring. And they reached the only conclusion you can reach. The game of suppressing the price is mathematically over. The bank that made billions by shorting silver just dropped $22 billion to go long. Why? Because the fundamental equation has permanently flipped. They aren't fighting the tide anymore. They are getting ready to profit from the flood that they know is coming. And, here is a critical detail that should honestly terrify anyone who is holding paper silver or just sitting on the sidelines waiting for a better price. JP Morgan's big flip happened at the exact same time the US Mint announced they were running out of silver coins. Think about that. The United States Mint, backed by the world's reserve currency with direct lines to every major miner and refiner on Earth, can find enough silver to make American silver eagles. If the US Mint is struggling to find physical silver, what chance does a regular retail investor have when they try to convert their paper ETF shares into actual metal? This is the signal, folks. When the biggest shark in the water closes its short position and buys 750 million ounces, they aren't gambling on where the price goes next week. They are reading the mathematical endgame and getting into position before everyone else figures it out. Silver is trading at $64.47 today. Yeah, that is already an all-time record high. But if JP Morgan is willing to put $22 billion into it at these prices, what do their internal computer models tell them silver is going to reach when the supply crisis becomes obvious to the whole market? Now, I know what you might be thinking. You might remember 1980, when the Hunt brothers tried to corner the silver market and failed spectacularly. But the difference between now and then comes down to one really critical thing. The Hunts used leverage. They used paper contracts backed by credit lines. JP Morgan is hoarding physical metal bought with their own balance sheet capital. Back then, the government forced the Hunt brothers to sell by changing the margin rules and cutting off their credit. But you can't force JP Morgan to sell bars that are physically sitting in their own vaults. There is no margin call on metal you actually own. There is no regulation that can force a private company to sell its inventory unless the government invokes national emergency powers. The betrayal here isn't that JP Morgan manipulated silver down for decades. We already knew that. They paid $920 million in fines and just kept going. The real betrayal is that they knew exactly when the manipulation would stop working mathematically, and they positioned themselves to make a fortune from the explosion, while retail investors are still waiting for the TV to tell them it's safe to buy. They bought 750 million ounces, spent $22 billion, and have zero short contracts left. When the wolf joins the sheep, you don't ask why. You realize the predator changed its strategy because the environment changed. The question isn't, will silver explode? The question is, do you understand what JP Morgan just told the market? Or are you going to realize what the signal meant only after the price has doubled again? Let's go back a bit to see where this story really started. It was 2011. That was when JP Morgan suddenly got approved to open their own COMEX silver vault, becoming one of only 5 places approved to store the metal. They started with absolutely nothing, 0 silver. But by 2017, just 6 years later, they controlled 112.5 million ounces. At the time, the total inventory on the COMEX was 213.3 million ounces. Do the math on that. That is 53% of all the silver backing the world's biggest paper derivatives exchange, all held by one single bank that has a documented history of price manipulation. This wasn't random. This wasn't just rebalancing a portfolio. This was a coordinated strategy, executed with surgical precision over years, to put themselves at the absolute choke point of the global silver supply. There was an industry analyst named Ted Butler who tracked this for years. He found something really interesting in the data. JP Morgan systematically stopped delivery on COMEX contracts. That means whenever they had a long position, they demanded the physical metal instead of taking cash or rolling the contract over like most traders do. Just between 2015 and 2016, they took delivery of 51 million ounces. In March 2017 alone, they stopped 2,189 contracts. That's 13.4 million ounces. That was way over the position limits that are supposed to stop manipulation, but nothing happened. Ted Butler even filed a formal complaint with the CFTC, but silence. No investigation, no enforcement. Why? Because JPMorgan wasn't breaking the system back then. They were quietly getting ready for the day the system would break itself. Fast forward to 2025, and the government data proves what Butler was warning about. The Commitment of Traders report, that's the weekly snapshot from the CFTC showing who owns what, reveals something extraordinary. In just 1 week this year, the commercial net short position, which is mostly big banks like JPMorgan, HSBC, Deutsche Bank, dropped by an insane 15,564 contracts. That represents 77.8 million ounces of paper silver. To give you context, an analyst named Ed Steer, who has watched this for 20 years, estimated that a big drop would be maybe 5,000 to 10,000 contracts. This is extremely rare. Usually, speculators are long because they want prices to go up and banks are short to hedge. Now, it's completely inverted. The smart money with the inside info is long and the dumb money chasing trends is short. Analyst John Rubino called this hyper-bullish. Basically, the banks stopped fighting the rally. They aren't capping prices anymore. They are ready to ride the wave they spent decades holding back. But here is the most damning evidence that the physical market is already broken, even if most people don't see it yet. On October 8, 2025, a buyer, rumored to be India, though nobody confirmed it officially, placed an order for 1,000 tons of silver in London. That is about 32 million ounces. Now, to be clear, that is barely 4% of annual global production. It's big, but it shouldn't have broken the market. The London Bullion Market Association, LBMA, claimed they had 844 million ounces in their vaults. Yet, they couldn't deliver 1,000 tons without everything seizing up. Lease rates spiked instantly from 0.25% to 200%. Every major trading desk pulled their liquidity. A huge Swiss refiner called Metalor actually announced they wouldn't trade silver again until January 2026. Let that sink in. The LBMA claimed to have nearly 24,000 tons of silver, but an order for 1,000 tons caused total paralysis. Why? Because according to their own rules, 4/5 of that inventory is owned by ETFs, like SLV. It's not available for sale, but the real question is, do those ETFs actually have the silver free and clear, or is it leased out to banks who use the same bars as collateral for other things? The freeze in October gave us the answer: the silver isn't there, not in the amounts they claim. The London market, just like the COMEX, is running on fractional reserves. Between June and October 2025, JPMorgan executed their flip with incredible precision. First, they closed that massive short position, 200 million ounces bought back in 4 months. That alone would have pushed prices up. But they didn't stop. They used the money they freed up to buy physical metal at a pace that is hard to comprehend. According to analysts tracking warehouse receipts, in just 6 weeks they added 21 million ounces to their stockpile. That is 300,000 ounces every single day for 6 weeks straight. Where did they find that much metal when the market was so tight? They raided COMEX vaults, ETF holdings, and made private off-market deals with miners. When you are JPMorgan, you can make calls retail investors can't. You can offer premiums nobody else can match. They structured deals to pull metal out of inventory that wasn't supposed to be available. This isn't hedging. This is the behavior of an institution that ran the numbers, saw a revaluation coming, and decided to grab everything they could before the price exploded. Critics will point to the Hunt brothers and say, corners always fail. But again, the structure is different. Nelson Bunker Hunt and William Herbert Hunt used futures and massive leverage. When silver hit $50, the regulators changed the rules. They raised margin requirements, imposed position limits, and even created Silver Rule 7, which banned new buy orders. The government froze their credit and forced them to liquidate. JPMorgan holds 750 million ounces of physical metal bought with cash. No margin calls, no debt. The government can't force them to sell unless they declare war or a national emergency. More importantly, JPMorgan isn't trying to corner the market artificially. They are just positioning themselves ahead of a supply deficit that is now in its 6th year. The Silver Institute projects a deficit of 117.6 million ounces for 2025. That is 6 years in a row where the world used more silver than it mined. That isn't a guess. That is structural reality. When you combine the accumulation since 2011, the short covering, the London freeze, and the $22 billion investment, the evidence is overwhelming. The paper market is insolvent. The banks know it. That is why they flipped. Let's look at the math JPMorgan's analysts probably used. Start with supply. 835 million ounces mined in 2025. Sounds like a lot, right? But then look at demand. Industrial use took 1.2 billion ounces. Solar, EVs, 5G, these aren't things people buy on a whim. These are supply chain requirements locked in years in advance. You can't build a solar panel without silver paste. There is no substitute at these prices. Factories don't stop. Then add investment demand. People are buying ETFs to hide from inflation. Retail buyers are paying $10 or $15 over spot price just to get coins. Central banks, especially in the BRICS nations, are dumping dollars and buying commodities like silver. This deficit means we are draining the above-ground stockpiles every year. Every year there is less silver in the warehouses, and every year more silver gets locked into industrial products like phones and cars that never get recycled. The math gets scary when you look at the COMEX again. Registered inventory is down to about 38 to 40 million ounces as of late 2025, but open interest is 200 to 44% of that. That means if even 41% of the people holding contracts asked for the metal, COMEX would collapse. They would have to either beg owners to sell or admit they can't deliver. That is structural insolvency. So why did JPMorgan buy at $60 or $65 an ounce? Because their models see something much higher. In 1980, silver hit $50. If you adjust that for official inflation, it's about $185 today. But if you use the real inflation numbers, the way the government used to calculate it before the 1990s, that $50 back then is equal to about $600 today. That's not a conspiracy. That's just math using consistent methodology. Also, in 1980, the demand was speculative. Today, industrial demand consumes 6 times what the Hunt brothers ever held, every single year. We need silver for technology. Alternatives don't become viable until silver hits $2,000 or $4,000 an ounce. JPMorgan is likely betting on $600 as a target. They are waiting for the moment when paper claims break and the price has to rise to ration the supply. Conservatively, maybe $100 to $150 by late 2026. If COMEX breaks, $200 to $300. If the paper market totally fails, we could see $400 to $600 or more. At $100 silver, JPMorgan's position makes a $53 billion profit. At $200, they gain $128 billion. That is why they bought at the highs. You need to mark 3 dates on your calendar. January 2026 is huge. First, China's new export controls kick in. They exported 660 tons in September alone. But if Beijing cuts that off, global supply takes a massive hit overnight. Second, JPMorgan has to return 4,000 tons of silver they leased from ICBC, the big Chinese bank, back in October to help cover that London freeze. If they can't find the metal, they face huge penalties or default. Third, Metalor returns to the market in January. Will they find silver to process? Or will their return show the shortage is worse? Then in February 2026, the March delivery contract begins on the COMEX. With inventories at 15-year lows, this will be the stress test. If people stand for delivery, COMEX faces that binary choice: find metal at any price or admit failure. Here's the thing JPMorgan knew but didn't tell you. The paper market is already mathematically broken. The freeze in London proved it. The lease rates proved it. The coin shortage proved it. While they told everyone silver was going lower, they were buying the biggest stockpile in history in secret. That $920 million fine was just the cost of doing business. They suppressed prices to buy cheap, and now they are ready to make tens of billions when the price corrects to reality. Silver is at 64.47. Analysts say it's too expensive. They say wait for a pullback to $50. Meanwhile, JPMorgan just put $22 billion in right here. Who do you trust? The media that wants you to stay calm, or the bank that manipulated the market for decades and just went all in with their own money? The betrayal is complete. They scared retail investors out while they bought in. They flipped from short to long while the TV said it was too late to buy. Now they are just waiting for the math to do what manipulation can't stop anymore: force a revaluation based on actual scarcity. The question isn't if this happens. The deficits make it inevitable. The question is, will you understand the signal JPMorgan just sent? Or will you wait for the news to tell you after the price has doubled or tripled? 750 million ounces, $22 billion, zero shorts. When the biggest predator switches sides, it isn't a warning, it's a countdown.